It's the Innovation Podcast with Mark Reed Edwards and Garnett Harriman. Let's start the show.
Hey, Garnett, how you doing?
Great. How you doing today on a snowy Wednesday?
Yeah, it's kind of chilly out there, but it's bright skies, which I always like.
Yep. Just enough to see all the snow turn into mud and sludge in New York.
Right. And we have a distinguished guest with us here to discuss opportunity zones. You want to kick it off, Garnett?
Absolutely. We have Peter Stewart, the managing partner and I think chief investment officer of a real estate investment group out of DC and New York called Outlier Capital. I'll let Peter do some, a little bit of his own background when he signs on, which I hope is right now. Hey, Peter, welcome.
Hey, Peter.
Hey, Garnett. Hey, Mark. Thanks for having me.
Thanks for being here. Do you want to do a little bit about your background and how you got to be in the cutting edge of real estate investing?
Sure.
That would probably be good for listeners, I think.
Sure. So I got my start actually flipping houses and primarily in Washington, D.C. So, if we want to tell war stories about flipping houses, I'm happy to talk about that. And then I went to work for a mid-sized developer in Washington, D.C., primarily working in emerging neighborhoods, which is now, obviously through the Opportunity Zone program, something where our firm is looking at a lot, and left that firm to found Outlier, primarily working at the time, and this was 5 years ago, one family office and their friends, and we've grown that capital base to include multiple family offices and super high net worth folks. And primarily we do two things. We invest in apartment buildings in the suburbs and execute a traditional value add strategy, which just means we go in and we fix appliances, we renovate, update countertops and cabinets, we fix a roof, we take care of all the deferred maintenance, we install professional management, and that strategy is primarily driven by cash flow. So we're trying to generate cash flow for our investors on a year-over-year basis. And the second thing we do is we do urban infill development, which is going to be most relevant for this conversation in the urban core. And primarily today in Washington, D.C., however, we're starting to look at other markets. So those are really our two swim lanes today.
Hey, I don't know about Mark, but I'm happy to spend as much time as possible on the cash flow discussion.
Yeah.
Any advice you got on that? I'm all ears, buddy.
Yeah, happy to talk more about that as well. And we've tried to overlay opportunity zones on top of that. Haven't done so successfully yet, but hopefully soon.
But I mean, for a guy who's started out flipping houses, I mean, they're all about cash flow, right?
Well, yeah. Well, we actually, when I first started, we were flipping, and this really rescued us in 2007, 2008. We were flipping high-end homes and didn't get impacted because in that high-end market, those folks have the ability to transact even when economic dislocation occurs. So, but again, happy to do lots of war stories from that decade.
Maybe a separate episode of this.
Exactly, a separate episode.
So we're talking about opportunity zones today, and two finance and investment geeks like myself and Peter, this is probably a fairly well-known entity, but to the vast majority of folks out there, it's much, much less well-known a quantity. So I'm just going to loop up to like sort of a macro backstory, and then I'm going to push it out to you, Peter, with some of these questions. And Mark, you jump in with whichever questions you want to jump in with.
Great.
So there's this thing. I'm erring on the side of like layman's terms, right? There's this thing called the Taxation and Jobs Act of 2017. I think it was kicking around since Obama and was not actually passed under Obama, but then was passed under Trump. Is that accurate so far, Peter?
You've got it. Yes.
Okay. And there were some luminaries involved with this think tank / PAC or, political action committee, or I'm not sure what they were when they drafted this recommendation and it eventually, became legislation. Some real luminaries from the like tech 1.0 or web 1.0 world the guy from Napster and maybe a few others, right? Is that also accurate? Or?
Yeah, that's right. Sean Parker, Ron Conway, I believe both of them were on the board. And I think Sean Parker particularly was involved with a group called EIG. And that group was the, you call them a quasi think tank that was instrumental in building a coalition in Washington to get particularly this piece of legislation into that 2017 Jobs and Tax Cut Act.
And I think EIG, just for the folks who are going to be fact checking this out there, as you should, is the Economic Innovation Group. If I'm not
That's
mistaken.
right. Yes.
So fast forward to 2017, it gets passed, and then again, layman's terms, is a free for all of capital raising since then. A veritable bonanza. A jubilee, I'm not even sure what to call it, of capital raising, all in the service of creating these opportunity zone funds. I skipped one major step, right? Let me back up to that. So sometime after passing and before the current round of jubilant fundraising, is it governors or mayors? I can't remember, or both, of states around the country were tasked with designating where these opportunity zones would be, that would be the subject of these investment, opportunities.
Correct. It was the governors and then the mayor of the District of Columbia.
Got it. And so that took some time. And those, I'm sure there was a whole lot of political infighting and backstretching and whatever else. But that got done, and those opportunity zones were officially approved. And now the fundraising has begun, and there are a lot of new opportunity zone funds out there, and we're going to spend some time just learning the ins and outs of what happens in an opportunity zone fund, why it's interesting to investors, and maybe some of the both pleasant and unpleasant consequences could be. So with that, I'm going to just start off with the first question, Peter.
Sure.
Unless you want to add anything to that, backstory piece.
No, that was a great introduction.
Cool. So what, after all, is an opportunity zone? And why should people care?
Yeah, I think that's a great place to lead off. So you talked a little bit about this. They were created by the 2017 Jobs and Tax Cut Act as a nationwide economic development initiative. What are they? They are over 8,700 census tracts, as you mentioned, in all 50 states, Puerto Rico, and the District of Columbia. And really, they were created to encourage investment in economically distressed communities. However, as I'm sure many of your listeners will find out by, reading the blogosphere, there are some zones, and I'm just speaking locally, there's a opportunity zone immediately next to Dulles Airport out in the kind of Tyson's Corner area. And in that zone, the median income is $80,000. So there's some zones that don't fit that description, but on the aggregate, opportunity zones had an average poverty rate of 32%. And to give you some context, the average in the U.S. overall is 17. So these are truly economically distressed communities in the aggregate. And another stat is that the median income in these zones is 37% below the national average, and the unemployment rate is higher by 1.6 times. The number of people that live in the zones is over 35 million, and approximately 77% of those zones are in metropolitan areas, which I think we're going to talk about later on in the show. So that's kind of what they are. The question you asked is the right one, which is, why should people care? And I think I like to go to synthesis, and there's a few interesting statistics and then a few kind of sound bites. But one of my favorites is Forbes said that, and I quote, "This is the most unbelievable tax break ever." So that says it all. The Secretary of the Treasury said that he thinks there will be over $100 billion invested in the zones over the next couple of years. And to give listeners out there a context, there's a program called the New Markets Tax Credit, which was also another economic development initiative. And in the past 17 years, there's been about $50 billion of allocations. And so Secretary Mnuchin is saying that he believes it's going to be double that in the next couple of years. So that kind of gives you some context. And then finally, U.S. investors currently hold about $6 trillion of unrealized capital gains. And that should give folks a sense of how big the market opportunity is, because at the end of the day, what this is a tax deferral and tax elimination tool. And so hopefully that gives folks some insight onto why they should care about this.
Sure. And let's get a little more granular on the why they should care, because, if even one or a small number of people get motivated from hearing this podcast, to invest in these funds, so that would be a good thing. So that 6 trillion number, what does that include? Is that unrealized capital gains from stock, from real estate, from...
Exactly. Stocks, real estate, it's anywhere there's a gain in an asset price, in an asset value.
And so that number is a testament to a couple of things. And I want to keep contextualizing this for folks so they can maybe, bring it closer to home for themselves, right? That really speaks to the level of economic success and wealth creation, maybe even unprecedented levels that have happened in this country in the last, 10 years for sure, maybe even 20, 30 years, actually. Is that a fair way of looking at it? I mean,
that's right. And I mean, if you want to use, I always like going to specific examples, but if you have a stock that you purchased for $10 and that stock is now worth $20 and you sell it, that's a $10 gain, right? So that could be then invested, the gain, the tax on that gain. So let's just use 20% of the $10. That $2 could be then invested into an opportunity zone. So that's really what we're talking about.
Yep. I mean, that brings it really close to home. So this is fundamentally, I mean, if I'm not really a good example of an average individual investor because of my day job, but this is fundamentally a rebalancing tool. So if I'm taking money off the table from an asset, stock, real estate, or anything else, and I'm looking to optimize, the post-tax, amount of gains, this is, the opportunity zone or some any vehicle related to an opportunity zone could be a great way to do that.
Absolutely. And I think that it may be helpful for listeners to hear, specifically how the program works.
Yep.
And the way that I have seen it broken down in the most elegant way, I'll call it, is you really think about it as in 4 kind of buckets. So the first bucket is if you take that capital gain, that $2, and you invest it in an opportunity zone, at a minimum, if you invest 0 to 5 years, let's call it, at a minimum, you defer the capital gains. So you'd have had to pay that capital gain this year. You've deferred it into the future. So that's bucket number 1. Bucket number 2 is if you hold that asset from 5 to 7 years. And if you hold it to 7 years, you have effectively reduced the tax that you owe by 10%. And it's truly an increase in basis, but it nets out to be reducing your taxes by 10%. So that's the second bucket. The third bucket is if you then hold that investment from 7 to 10 years, you not only defer the taxes, but then you reduce the taxes by 15%. And then the fourth bucket, which is truly the most powerful tool, and what the government is trying to incentivize people to do is to invest over the long term in these economically distressed neighborhoods. The fourth bucket is if you hold this investment for more than 10 years, you not only defer your taxes, you not only reduce your taxes by 15%, but you also eliminate any capital gains tax that you would have realized based on that investment. And so let me talk about what that means. So using that $2 that someone invested, if that $2 earns $10 over the course of that 10 years, that's tax-free. You do not pay capital gains tax on that amount, which is, in my mind, as a real estate investor, as someone who likes to own assets over a long period of time, is an unbelievable opportunity.
So always trying to simplify. And I'm going to hit you up for the 4 buckets language when we finish recording this podcast.
Sure.
Which I really like because there's a comprehensive nature to going through it that way. I have heard a couple of really interesting ways of looking at it. And one guy I know who's maybe a 30-year real estate investment CFO type from the commercial real estate industry is fond of saying, essentially, it's a 1031 exchange for everything, not just real estate. And if you hold it for the full 10 years, then it acts like a Roth IRA.
Right.
And I thought that was kind of an interesting way of looking at it, coming from a very sophisticated commercial real estate CFO type.
I completely agree. And it's amazing because you mentioned 1031s. And the limitation there is you have to have a quote unquote like kind exchange. And we deal with 1031s all the time. And it's a challenge, right? Because you're then boxed in to one investment type. And the brilliance of this tool is that you can invest in companies, you can invest in real estate, and it gives you a much broader spectrum of opportunities.
Well said. Well said. Let's move on a little bit, and then we'll have time to maybe revisit some of this. Why should people care, and how does it affect them individually, personally? Let's dive in a little bit more into the nitty-gritty on the how you operationalize this sort of investment. So how does an investment in an opportunity zone fund /property/enterprise work?
Sure. We talked a little bit about what the benefits are in those 4 buckets, but there are a couple important things to note. So one is there's all this reference to qualified opportunity zone fund. And what does that mean? Is it a fund like a traditional, you go and invest in Carlyle Group and, there's a fund? Not necessarily. All that means is it is a partnership or LLC that is formed for the purpose of investing 90% of its assets into a qualified opportunity zone. So as an example, we have explored just creating a simple LLC. In the operating agreement, it will say the purpose of this is to invest in a property in an opportunity zone. And that technically is an opportunity zone fund. So that's the first thing of note. The second gets to what can you invest in? And that's really, what we said earlier, the spectrum is broad. You can invest in stocks, in partnership interest, or business property, or actual physical real estate. And I think the key things for investors to know are you have 6 months from the time that you realize a gain to make an investment into an opportunity zone fund. And then that fund has 6 months to deploy the capital into an opportunity zone fund. And one thing that I will note is, and this really goes for our entire conversation, and there was a hearing just last week at the Internal Revenue Service about this. There's so much we don't know yet. So this is evolving. And so everything that I'm saying, today is kind of what we know today. But as an example, that 6 months for a fund to deploy capital, Steve Glickman, who used to be with EIG, he presented to the IRS last week. And one of the things that he said was, we should give funds more time to deploy capital. And I tend to agree with him, but that may change. So once that capital is deployed, and the other 2 things to know is, one, it's a self-certification process.
You beat me to the punch. That was going to be that, because that is intellectually and business-wise, and from a legislation standpoint, the whole self-certification piece is, I think, going to be very counterintuitive to a lot of people. So, what is that?
It all it means, and if you go on and Google it, you just Google Form 8996, right? And it's a 2-page form. It's like with the IRS, the instructions are 8 pages, right? But the form itself is 2. But really what it's asking is, did you form this entity to invest in opportunity zones and be an opportunity zone fund? And so that's self-certifying. Yes, we did, check that box. And then are 90% of the assets invested into an opportunity zone? And they do testing, quote unquote, twice a year. And again, it's all self-certifying. All that means is that if you are the administrator of that opportunity zone fund, quote unquote, you have to represent that is true and accurate. And this is another area where there are lots of questions around, okay, well, how is this going to be tested? What is the audit going to look like for this? So a lot to come, but today it's a self-certification. And the other important thing to note is that if you are investing in real estate, the requirement is the language is substantially improve the property. And what they have said, again, to date, what that means to them is that you must improve the property by an amount at least equal to the amount that you invested into purchasing the building. And there's a lot of kind of tax nuance. They don't count the land value, but ultimately the way that we have interpreted this is you need to spend at least as much money as you did buying the building to improve it. And you need to do that within 30 months of making the investment.
So you stole my thunder on the self-certification. I'll give you that one. Now let's move on to the second thing that I was super curious about. You pointed at it a little bit in referring to this recent IRS hearing. My understanding is that one of the big issues that came up speaks to my second concern, which is what's the definition of an approved or qualifying enterprise investment in an opportunity zone? It seems to me like there was a lot of obfuscation. There seemed to be a lot of restrictions around how you could invest in an actual going concern, a business or an enterprise. And I think that came up in this most recent hearing. Is that your understanding?
Yes. So, as I mentioned, you can invest in stocks or partnership interests, which means you can invest in businesses, right? Mm-hmm. And I know
with some notable exceptions, right? Like the sin industries or something like that.
Exactly. They call it vice businesses, right? So golf courses, country clubs, massage parlors, suntan facilities, racetracks, liquor stores. Those are the
no racetracks and no liquor stores.
Garnett and Mark, you guys are. This isn't for you.
That's it. We're done. See you later. Don't let the door hit you.
Right. And there's some other. There's some other things. Investing in businesses, like you have to have. I mean, again, today, 50% of the total gross income must be derived from the business that you conduct within opportunity zones. And so, that there are those other, rules and regulations just to keep in mind if you're making a business investment as opposed to a real estate investment.
All right, that's part one with Peter Stewart. Next time we go deeper on opportunity zones and learn the three most important things to know about them, how Peter is capitalizing on them at Outlier Capital, some common mistakes. We also get a broader understanding of opportunity zones in general. That's next time. In the weeks ahead, we will be talking with Mark Gallagher about innovation in the world of F1, Daniel Ray about the innovation he heads up at Ultimate Guitar, Francesca Gino of Harvard Business School about how Rebels can help a company embrace innovation, and we're also planning discussions with experts in elder tech and esports. So stay tuned.
Thanks for joining Garnett and Mark on the Innovation Podcast. Visit innovationpodcast.co to subscribe and listen to other episodes.